practice problems for Chapter 2. The point of this is to test your knowledge on financial statements, right? So what we're going to do is calculate each one of these, and I'll give you some information, some financial statement information about a firm, and you'll have to figure out the pieces to calculate what it is that I'm asking you to calculate. So let's look at the first example, calculating shareholders' equity. Let's suppose you're looking at a firm and it has common stock of $89, total liabilities of $405, current assets of $380, and net fixed assets of $590. What is the amount of the shareholders' equity for this firm? All right, well, the first thing you want to remember is the balance sheet identity, which says total assets is equal to total liabilities plus total equity. All right, so what we're looking for is this total equity. But let's also remember that assets can be broken down into current assets and net fixed assets. And also, just to remember, total liabilities can be divided into current liabilities and long-term debt. All right, so those are basically the pieces that we're working with. So let's see if we can back out total equity given what we're given the information in the problem. All right, well, first thing we're going to do is look at this right here. Current assets is $380. That is this right here, $380. And net fixed assets is $590. So we'll jot that down and put that right there. Total liability, so these two together is $405. And then total equity is what we're solving for. So you can see what we need to do is push total liabilities to the other side. And so we'll combine total assets as 380 in current assets plus 590 in net fixed assets minus total liabilities of 405. And that gives us $565 in equity. So again, just to recap, what we did was we started with the balance sheet identity, which says total assets is equal to total liabilities plus total equity. And we remembered that total assets can be divided into short-term and long-term components, and total liabilities can also be divided into short-term and long-term components. We looked at the information that we were given in the problem, and we pieced it together to back out the total equity, which we found to be $565. All right, let's move on to the next one and see if we can figure it out. Calculating market value. This is kind of a long problem, but let's read and see what we're given. Recently, the owner of Friendly Flowers encountered severe legal problems and is trying to sell her business. The company built a building at a cost of $1,140,000 that is currently appraised at $1,340,000. The equipment originally cost $620,000 and is currently valued at $367,000. The inventory is valued on the balance sheet as $310,000, but it has a market value of only one half of that amount. The owner expects to collect 98% of the $175,200 in accounts receivable. The firm has $11,700 in cash and owes a total of $1,340,000. The legal problems are personal and unrelated to the actual business. What is the market value of the firm? All right, so the first thing we need to recognize is there's a difference between book value and market value. What we're given in the accounting statements is book value. And again, that is not representative of market value. So in this problem, we're asked to calculate the equity market value of the firm. Okay, so we're going to look at the information we're given and make sure the numbers that we're adding up are representative of market values and not book values. Okay, so the first thing is the building, right? We have this building. It originally cost $1,140,000, but that is unrelated to what it's valued at today. And that is currently, or at least it appraises for, $1,340,000. So the first thing we're going to write down is this $1,340,000, which is the appraised value of the building that the firm owns. The next thing is the equipment. Now you can see the equipment originally cost $620,000, but that original cost is unrelated to what it's valued at today, which is $367,000. So we're going to add $367,000, which is the estimated cost of the equipment. If we had to sell it today, what could we get for it? All right, what else does the firm own? Inventory. Let's see. Inventory on the balance sheet is valued at $310,000, but we know that the market value is probably only half of that. So we put in $310,000 multiplied by 1/2. And then we have accounts receivable. Now, accounts receivable on the balance sheet is at $175,200, but the owner expects to only collect 98% of that. So we add $175,200, but multiplied by 0.98 because that's what we expect to collect. And then lastly, we have cash. Okay, so we add in that cash, and that is $11,700. And that is what the firm owns. So in terms of the market value of assets, that's what it's going to represent. But the market value of equity takes the market value of assets and subtracts out what is owed in terms of debt. So we subtract out $1,340,000, and that gives us our market value of equity, which is $705,396. Okay, so again, just to recap, what we did here is we recognize from the get-go that we need the market value. So when we look at what we're given and we add up what the firm owns, we want the best estimate of market values and not book values, right? Book values represent sort of represent historical costs. That is not what we want, right? We want market value, which means if we had to sell the asset today, what could we get for it? That's what market value represents. All right. Next question, calculating net income. Big Vans for Rent paid $476 in dividends and $583 in interest this past year. Common stock increased by $193 and retained earnings decreased by $119. What is the net income for the year? All right, so this is interesting because we're given this information about dividends and interest and retained earnings, and we're being asked, what is the net income? Well, it's important to understand what net income actually represents. It's income available to shareholders, right? Now, that income can be divided between a portion that stays with the firm and a portion that gets paid out to investors in the form of dividends. So when we need to calculate net income, what we're going to look at is dividends and retained earnings. Now, the first thing is going to be dividends. So we'll write down net income is equal to the dividends paid plus the change in retained earnings. So dividend paid is $476. So we're going to go ahead and jot that down. The change in retained earnings is interesting in this case because retained earnings actually decreased. When the firm has a positive net income and puts a portion of that away as retained earnings, we expect retained earnings to increase. So an increase in retained earnings represents an increase, a positive value in the net income. But in this case, we have retained earnings that decreased by 119. So what we're going to do is instead of add this value, we're going to subtract it. And that gives us a net income of $357. So again, just to recap what we just did, was we calculated net income, not from revenues and expenses and all that. What we did was we looked at dividends paid and change in retained earnings, right? Because net income represents the income available for shareholders. And that income can be divided between a portion that stays with the firm in the form of retained earnings and a portion that gets paid out to investors in the form of dividends. So if we want to rebuild net income, then we look at dividends and retained earnings. In this case, it was interesting because retained earnings decreased, which means we actually subtracted out in this equation. Okay, next problem. Operating cash flow. All right, so your boat rental company has net income of $371 on total sales of $1,460. Costs are $800 and depreciation is $130. The tax rate is 30%. The firm does not have any interest expenses. What is the operating cash flow? Okay. Well, first of all, remember the equation for operating cash flow. So I'm going to write that up here in the upper corner. Operating cash flow is EBIT plus depreciation minus taxes. Okay, so we're going to keep that in mind. So in order to calculate the operating cash flow, we need each of these components. You can see we're given depreciation. We're not given taxes directly, but we're given the tax rate. We're also given the information we need in order to calculate EBIT. All right, so first we see total sales is $1,460. So let's go ahead and write down EBIT right here because we're going to calculate it. And EBIT is going to be calculated as total revenues minus expenses or costs minus depreciation. Right, that's the general form of EBIT. And you may have something, you may have more details with respect to the expenses, but we're going to keep it simple here and just say EBIT, what that represents is revenues minus operating expenses minus depreciation. And we're given that information in the problem. So revenues are $1,460. Expenses or costs are $800. And depreciation is $130, which gives us an EBIT of $530. Now, the firm does not have any interest expenses, otherwise we might take them out before we calculate taxes, because interest expense, like interest payments, are tax deductible. All right, so taxes, so we'll write taxes owed is equal to 530 multiplied by the tax rate, which is 30%. So we'll multiply that by 0.3. And that gives us taxes owed as $159. All right, now we can look back at our operating cash flow equation and say, hey, we have everything we need in order to calculate it. So operating cash flow is equal to EBIT, which we calculated to be 530, plus depreciation, which is given to us and is 130, minus taxes, which we just calculated, which is $159. That gives us a total operating cash flow of $501. All right, so just to recap, what we did was we were asked to calculate the operating cash flow. So what we did, the first thing we did was wrote down the operating cash flow equation, which is this right here. It equals EBIT plus depreciation minus taxes. And then we said, wait a second, we don't know EBIT or taxes, so we have to calculate EBIT. Now, EBIT is relatively straightforward, right? We start from revenues and then take out operating expenses, and then we further take out depreciation, which is a non-cash expense. We found it to be 530, and we used that number to calculate the taxes owed, which was 159, which could have been lower if the firm had interest expenses, but it didn't. And then we went back to the operating cash flow equation and added together EBIT plus depreciation minus taxes. Next problem. Cash flow to stockholders. All right, so Jeff's Restaurant Enterprises has a net income of $280. The firm pays out 37% of the net income to its shareholders in the form of dividends. During the year, the company sold $73 worth of common stock. What is the cash flow to stockholders? All right, so this is important because we're calculating the cash flow to stockholders. So money going from the firm to shareholders, that is going to be positive. So if the firm pays a dividend, that is a positive cash flow to shareholders. If the firm raises capital and sells shares of stock, then that would be a negative cash flow to stockholders because stockholders are now providing capital to the firm. So it's important to make that distinction before we begin. But let's just start with the equation. Cash flow to shareholders is going to be this net income, $280, multiplied by 37% because that's how much they pay as dividends, to shareholders. So 280 multiplied by 0.37 gives us, this represents dividends paid. But at the same time, we're also given this piece of information that the company sold $73 worth of common stock. What does that mean? That means that the firm went to the financial markets, to the stock market, and said, I would like to raise equity capital. I have these shares for sale. Let's do business. And the company sold $73 worth of that common stock. Now, this is cash going from investors to the firm, which the firm will then use, right, to pursue projects and investments and all that. So in terms of cash flow to stockholders, we are going to subtract out this $73 because it represents a cash outflow from the perspective of shareholders, right? Because the shareholders are giving cash to the firm. So overall, in terms of the cash flow to stockholders, we have dividends paid as a positive contributor to that, and this $73 as a negative contributor to that. And the result is $30.60. That represents our cash flow to stockholders. Next problem. Calculating net fixed assets. All right, so your used furniture business has total equity of $2,175, net working capital of $245, and long-term debt of $1,080, and current liabilities of $4,710. And we are asked, what is the company's net fixed assets? All right, so let's start with our balance sheet identity, which says total assets is equal to total liabilities plus total equity, right? And this can be further broken down into current assets and net fixed assets. Total liabilities can also be broken down into current liabilities and total or long-term debt, right? All right, so we're going to use this information to see if we can figure out this number here, net fixed assets. So let's think about what we've been given. We have total equity, so that's check. We have net working capital, which we haven't talked about yet, but we'll get to in a second. Long-term debt of $1,080, and current liabilities of $4,710. Okay, we can already see we can piece this whole side together. So let's go ahead and do that. So we have this total equity. We'll go ahead and jot it down here, $2,175, plus this long-term debt of $1,080, plus the current liabilities of 4,710. That gives us 7,965. That represents the total liabilities plus total equity, or in other words, total assets. So all that we need now is current assets. If we can figure out current assets, then we can figure out net fixed assets because now we know total assets. All right, well, what is net working capital? Net working capital is current assets minus current liabilities. How many current assets you own in excess of current liabilities? Now we're given net working capital, which is 245. So let's go ahead and fill out this equation. 245 is going to be our net working capital. And our current assets, which is what we don't know that we'd like to know, minus current liabilities, which is given to us, 4,710. So if we do the math, we find that current assets is equal to 4,955. All right, now we have the information we need to calculate net fixed assets. Okay, so total assets is equal to current assets plus net fixed assets. And so total assets is this number here, so 7,965, plus, or equals current assets, 4,955, plus net fixed assets. So if we do the math, net fixed assets is equal to 3,010. All right, so this was a lot. But let's recap what we did. Now, we were asked for net fixed assets, which we know is a part of total assets, right? Because total assets can be broken down into current assets and net fixed assets. We filled out the rest of the balance sheet identity with total liabilities and total equity, and then we further noted that total liabilities can be broken down into current liabilities and long-term debt. We used what we were given to fill out this side right here, which was 7,965, which represents the amount of total assets that the firm owns. We were also given a hint of net working capital. So we used the net working capital equation, which is equal to current assets in excess of current liabilities, to back out the current assets that the firm owns. So then we just used the equation total assets is equal to current assets plus net fixed assets to back out what net fixed assets was, which is 3,010. All right. Next problem, net working capital. So you're examining a company's balance sheet and find that it has total assets of 20,207, a cash balance of 2,073, inventory of 4,753, current liabilities of 5,509, and accounts receivable of 2,597. What is the company's net working capital? Well, why don't we start with the definition of net working capital, which we just talked about, which is equal to current assets minus current liabilities. Now, current assets can be broken down into multiple parts. And in fact, what we've been given here is cash, inventory, and accounts receivable. All three of those are current assets. So we can sum them together to find total current assets. All right, so cash is 2,073 plus inventory is 4,753 plus accounts receivable is 2,597. That sum together represents our current assets. And then we're also given current liabilities, 5,509. And that fills out our total net working capital formula. So we do the math, and we find it's $3,914. And that is our net working capital. Next problem. total equity. Your homemade ice cream business has the following financial information. Net working capital is $1,125. Fixed assets is $7,425. Total assets is $11,750. Long-term debt, $4,433. What is the company's total equity? All right. Well, why don't we start here? We've seen it multiple times now, but total assets is equal to total liabilities plus total equity. And we also know total assets can be broken down into current assets, net fixed assets. Total liabilities can be broken down into current liabilities and long-term debt. All right. Now we're asking for, or the problem is asking for total equity. So total equity is what we're going to be solving for. So we have to use what we've been given to back out the value of total equity. Why don't we start with current assets? Because you can see what we're given is net working capital and total assets. Okay, so why don't we start there? Current assets is equal to total assets minus the net fixed assets. So total assets is $11,750 minus fixed assets, which is $7,425. That gives us current assets of $4,325. All right. Now, what we've also been given is net working capital, right? We've seen that equation a few times. Net working capital is current assets minus current liabilities. Which ones do we know at this point? Well, we know what net working capital is because it's given to us, so why don't we write that down? And we know what current assets is because we just calculated it, $4,325. We don't know what current liabilities is, and that's what we're going to solve for. So we do the math here, and we find that current liabilities is equal to $3,200. All right. So what do we know now? Do we know enough to calculate total equity? Well, let's sit back and think about it. We know total assets, so check. We know current liabilities because we just calculated it, so check. And we know long-term debt because it's given to us, so check. All right, so we take total assets, $11,750, and we subtract out total liabilities, which is current liabilities plus long-term debt. So we'd subtract out $3,200, and we further take out long-term debt, $4,433. And that gives us total equity of $4,117. All right. So just to recap, what we did here is the problem is asking for the company's total equity. So the first thing we did was wrote down the balance sheet identity, and then we reminded ourselves that total assets can be broken down into two components, and total liabilities can be broken down into two components, both short-term and long-term. Then we looked at the information that we were given. Some of it is straightforward. Fixed assets, total assets, long-term debt. Net working capital is a little bit more tricky, but it's still relatively simple. It's just current assets minus current liabilities. So we used that information to back out current liabilities. So then we had all the pieces of information we needed in order to calculate total equity, and we found it to be $4,117. Next problem. Cash flow to stockholders. Again, at the beginning of the year, Vendors Incorporated had owner's equity of $48,485. During the year, net income was $4,925, and the company paid dividends of $3,585. The company also repurchased $7,335 in equity. Interesting. Repurchased. What was the cash flow to stockholders for the year? All right, so let's think about this. Cash flow to stockholders. Now, it consists really of two components, right? And think about it from the stockholder's perspective. The cash flow coming in is from dividends that the company is paying, and the cash flow going out or in also has to do with whether the company raised new equity or repurchased equity. And what that means for shareholders is a cash inflow, right? So if the company issues new stock, then cash is going from investors to the company. And that would make cash flow to stockholders negative or contribute negatively. But on the other hand, if the firm uses cash to repurchase stock, then that cash is going from the company to shareholders. And that is going to be a positive contributor to cash flow to stockholders. All right. So first of all, we're going to look at these dividends right here, and we're going to add them in. 3,585. If you can see that. And we're going to add the amount that the company repurchased, 7,335. And that together is 10,920. And that is going to be our cash flow to stockholders. So again, there are two components. One is the dividends. That is cash directly from the firm to stockholders. At the same time, we also have this repurchased equity, repurchased stock, which is also cash flow from the firm to shareholders, though the company is buying stock, so it's a little bit indirect for shareholders, rather a little less direct than dividends would be. But the total cash flow to stockholders is $10,920. All right. I hope this was helpful. If you have any questions, feel free to contact me.